Hello, my name is Matthew Granger and this is the FCTO Weekly Review and Outlook for July the 15th, 2012. Just as risk aversion seemed to be back as the main driving force in the markets, US equities staged a strong rebound on Friday on the back of JP Morgan's Chase's earnings report. The tide was suddenly turned as the dollar turned negative against the yen, sterling, Canadian and the Aussie dollar. Sterling was particularly impressive on safe haven flow from the Eurozone and was given a strong boost from strength in financial stocks. Meanwhile, the euro continued to be the weakest currency together with the Swiss franc on the never-ending debt crisis. Indeed, the euro's sell-off against the commodity currencies has intensified after the European Central Bank cut the deposit rate to zero. Judging from the price actions on Friday, US equities will likely regain strength in the near term. The Aussie should gain most from risk appetite, followed by the Canadian dollar and the sterling. The dollar and yen will probably turn mixed despite last week's rally attempt. The euro could recover a bit against the dollar and yen, but should continue to be weak. Selling euro-Aussie dollar, euro-Canadian dollar and to a slightly lesser extent euro-sterling will continue to be the better near-term strategy as price actions could be quite mixed elsewhere. In the US, the Federal Open Market Committee meetings for June the 19th and 20th meeting was somewhat of a disappointment to investors. There was no lengthy discussion on the options for additional stimulus. Indeed, the Fed just noted that a few members viewed further policy stimulus would likely be necessary. Several others said additional policy action could be warranted if economic recovery were to lose momentum, if the downside risks to the forecast became sufficiently pronounced, or if inflation seemed likely to run persistently below the committee's longer-run objective. Meanwhile, 6 policymakers expected the first rate hike to be in 2015, and it's getting more likely that the low-rate pledge could be extended. Fitch affirmed the US's AAA credit rating, but the outlook remained negative. Fitch noted that the rating is underpinned by its highly diversified and wealthy economy, monetary and exchange rate flexibility, and the exceptional financing flexibility afforded by the global reserve currency status of the US dollar. Also, the agency noted that fiscal and macroeconomic risks emanating from the financial sector are moderate and diminishing. Fitch expects that the economy will gradually accelerate into 2013 and 2014. They do not expect to resolve the negative outlook until late 2013. In the Eurozone, finance ministers agreed to speed up the bailout for Spanish banks was 30 billion euros to be ready for the end of this month. The agreement will be finalised on July the 20th after getting approval of the member states' parliaments. Spain is expected to set up a separate company to manage the assets of the recapitalised banks. The maturity of loans to Spanish banks will average 12.5 years and be eventually taken over by the European Stability Mechanism. In addition, Spain will be given an extra year until 2014 to meet its deficit reduction targets. Germany's Constitutional Court delayed its decision on the Eurozone's permanent bailout fund. It could take months rather than weeks before reaching a conclusion. The European Stability Mechanism Fund is originally expected to replace the temporary bailout fund, the European Financial Stability Facility, in early July, but it couldn't come into operation before the German ratification of the treaty. Moody's downgraded Italy's government debt ratings by 2 notches to Baa2, down from A3, and that's just 2 notches above junk level. The rating agency noted that Italy's near-term economic outlook has deteriorated and manifests in both weaker growth and higher unemployment, which creates risk of failure to meet fiscal consolidation targets. Also, the risk of a Greek exit has risen and the Spanish banking system will experience greater credit losses than anticipated, and Spain's own funding challenges are greater than previously recognised. The European Central Bank said that the overnight deposits dropped by more than half to 324.9 billion euros, the lowest level this year. That's an instant reaction to the ECB's central decision to cut the deposit rate to 0. The Bank of Japan unexpectedly increased the size of the asset purchase program by 5 trillion Japanese yen to 45 trillion. However, the size of the fixed rate loan program was reduced by 5 trillion to 25. Effectively, the total size of the stimulus program was kept at 70 trillion yen, with just some slight tweaking. The bank also voted unanimously to keep overnight rates unchanged at the 0 to 0.1% range. Regarding inflation, the Bank of Japan forecasts inflation to rise to 0.7% in the fiscal year starting 2013. That is, it will stay below its 1% target at least through early 2014. Regarding the economy, the bank lowered GDP growth forecasts this fiscal year to 2.2%, down from prior projection of 2.3%. Separately, the Bank of Korea lowered its benchmark borrowing rate by 25 base points to 3%, the first cut since 2009. China's GDP slowed more than expected to 7.6% year-on-year in Q2. That's the worst number in 3 years, and compared with Q1's 8.1% year-on-year. Nonetheless, it's somewhat of a relief to markets, as the figures were just a touch below expectations of 7.7% and were still above China's 2012 target of 7.5%. Based on the data, the soft landing scenario is still on track, and more monetary and fiscal stimulus would likely be provided to ensure the growth target is met. CPI slowed more than expected to 2.2% year-on-year in June, whilst PPI dropped more than expected by 2.1% year-on-year. Trade surplus jumped to a 3-year high of $31.7 billion in June. However, imports rose less than expected by 6.3% year-on-year, comparing to market expectations of 11 to 12%. Export, on the other hand, slowed to 11.3% year-on-year. The data raised concerns of the strength of China's domestic demand. And that's it. For a more detailed analysis and daily updates on all the news affecting the Forex market, please join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.